All right, welcome to another presentation. We're going to start again today, like we do most weeks, with looking at the S&P 500. You can see we have a steady uptrend, and we have well-defined channels we're going through. It's in an uptrend. You can see that we're approaching the 150-day moving average. And that has been very consistent in support for the stock market. And we started following that last week. You can see that we're approaching oversold. When we hit 20 on our slow stochastics, that's usually an indication that the market is starting to be fearful. And that's when you should start being greedy and start looking to buy things. Okay, so um, yes, you can see that we're also approaching our channel line, which is really close to the 150-day moving average. So that's lining up pretty good. All right, so let's look at our meeting notes. We can see we've had September as red since the beginning of the year. There's a well-known phenomena that I don't know if it's a self-fulfilling prophecy, but September has traditionally been a bad month in the stock market. Let's look a little bit further down in our notes here because I have a good article in a Wall Street Journal. Here it is. September is once again a tough month for stocks. S&P dropped sharply last week, 4.2% on worries about a slowing economy. Is this a self-fulfilling prophecy? Is the whole stock market waiting for the market to go down in September and everyone just sells? I don't know, but you can see that since 1928, according to the Wall Street Journal, September has produced a return of over 1% negative return. So it's living up to its reputation as a tough month for stocks. Okay, so that being said, you have to invest knowing that there are good times and bad times. And when we know a month is possibly bad, you want to wait. You don't want to buy your whole portfolio the week before that. So for me as a long-term investor, you have to basically just understand there's going to be volatility this month, and you have to wait it out. Okay, what's happening this month? There's no earnings coming out. Well, there's not that many earnings coming out. Over 90% of the S&P has already reported their earnings for the quarter. What's happening is we have an iPhone release. Apple is going to release an iPhone this week. That could serve as a catalyst up or down. There's going to be a debate happening. Also, that's going to give a little more certainty to who's going to be the president. We have a CPI coming out. That's going to be important information about the inflation. Then next week we have a Fed meeting, which they will either reduce, they'll reduce the interest rates by at least a quarter point, maybe 50 basis points. We don't know, but that's right in the middle of September, which we know is bad. We have a holiday. What is it? What is the? Well, no, we have end of quarter window dressing. So September is traditionally a bad month, but towards the end of every quarter, you have hedge funds, money managers that pile into stocks that have done good in the month so that they can have the top 10 that looks pretty good. And October is known for crashes because some of the biggest crashes in the world in the United States history in the stock market came on October, but actually historically it's been a good month. So I have it as green um, because we're going to have a tailwind of interest rates going down and um, but we don't know really what's happening. Well, we don't know what's going to be the effect of these interest rates. And so let's see what happens September 1st. All right, so let's look at some of our talking points. S&P is down 4.2% from last week. That is pretty bad. 66% of stocks are over their 200-day moving average. That is weakening. So we have a weakening market. Momentum is going down. It was 76% above the 200-day moving average last week. Now it's 66%. Earnings season's almost over. We have a couple more companies reporting this week. We hope the debates this week increases the certainty of who's going to be president. And market likes certainty. When there's uncertainty in the market, usually the stock market goes down. Okay, so the U.S. Treasuries, they are actually down 4% this month. We had some inflation readings, and no, we had some job um, information coming from the government that spooked the markets. And the markets thought that there could be a recession on the horizon. And there's a lot of good economists saying that that's not true at all. So I don't think there's going to be a recession. A lot of the smart people I follow say there's not going to be a recession. So recession usually is equivalent to maybe 1 or 2 months of poor market performance, maybe down 10% or 15% in the stock market. But the Fed usually comes to a rescue after a recession. So that's nothing to really be super scared about. And recessions happen less than 10% of the time. So um, if the stock market's going up 80% of the time, you want to be on that side of the equation rather than waiting for a recession and betting on a recession. Okay, all right, so our reversion to the mean is really doing much better now. Our healthcare, telecom, financials, energy, no, energy isn't doing so good, but financials, utilities that did worse last year are doing better this year. After this week of a down tech, the actual utilities is the best sector of the year, believe it or not. So we'll keep following that. I'm going to go over. Okay, well, we already reviewed this. Average monthly stock returns for the past 20 years, 40 years. September has been the worst. So we already knew from the beginning of the year that September would be bad. Okay, so we are at our stochastics approaching oversold levels, like super oversold. We're still going down in stochastics, but we do have support in the 150-day moving average and our trend line support right about here. So in the worst case scenario, not worst, but we could go down to here and bounce and go up here and as our next little formation. But we remain above the 150-day moving average, which is where our trend line intersects with the green line here. All right. So we don't have a correlation at all between the Treasury yields and the S&P 500 anymore. It was an inverse correlation for the longest time. Now, this week, whenever the rates are going down, stock market went down with it. So we don't have any, we can't count on this as a little indicator of where the stock market is going anymore. It seems like whenever the interest rates go down now, that's kind of scaring people that the economy is not going to be growing and maybe going into a recession. So the economy's slowing. If the economy slows, this yield will go down further. So same issue with the 2-year. You can see the 2-year yield has been dropping like a rock, and the S&P right now is going down with it. All right, so you can see that the price of oil is going down. And we've been saying for at least a couple of years, the price of oil going down usually indicates economies around the world are going down or slowing down. Maybe slow down. There's slowdowns and there's recessions. Right now, a lot of the economies in the world are slowing, but they're not in recessions. The inflation rate is going down. It's currently around 2.91%. It was 3% last week. So the dollar index isn't changing. It's still in a downtrend, but lately it's not changed. Gold is kind of consistently, it's kind of unchanged also. The US dollar index is still in a downtrend. Fear and greed index, returning to fear. It was fear last week. We had we had a little bit of extreme fear this week, but it went back to fear. So right now, the translation, if people are fearful, it's time to start looking for things to buy. We had some massive sell-offs in the past week, especially in tech stocks. So usually, sometimes whenever stocks sell off for 10% or more, that's called going down in integers. If that happens, then you have to see, well, are they going down for good reason or not? So I don't understand this. I don't even know if this is being updated. This AAII survey, they're still bullish. There is no bearishness in this report at all. So I guess if you compare it against last week, they're getting a little bit less bullish, but they're still bullish. So we don't have any contrary indicator that matched our fear indicator here. All right, so the VIX is going up a little bit. We have fear beginning to creep into the market. It was down at a historical low level for a long time. We had a little blip going up to 60 on August 5th, but we're back up to 20 right now. So as the stock market sells off, VIX usually goes up. Okay, so if we look at our emotional indicator graph, right now we're at the fear mode. We had a feeling, just a feeling of a little bit of capitulation this week where things every day went down more. And 4% is one of the worst weeks for the NASDAQ in many years, maybe back to the pandemic. So so the basic fear this week was the economy might be going into recession because the job picture, we're not adding as many jobs and the unemployment rate went up. Okay, we're still watching this currency trade to see if maybe there are some remnants of that could cause the stock market to crash. But we're oversold right now. So usually when we're fearful and there's capitulation, that's the time to start looking to buy things if you have some money to invest. All right, I found this little chart. It's a Merrill Lynch investment clock. I thought it'd be interesting to go over this. There are different cycles in the stock market. There's a boom cycle, slowdown, recession, and recovery. So right now we went through a boom after COVID lockdowns. We had a boom. We can see from the economy and from raising interest rates, whenever the economy gets hot, the Fed raises interest rates. So as the Fed raises interest rates, that introduces slowdown. So I figured in this chart, we're about right here. I put the X right where we're at right now. We're starting this slowdown process. And maybe here, I'm not sure. But during the slowdown process, Merrill Lynch recommends buying short-term treasuries, defensive sectors, high-quality assets, long-term treasuries. So that's during the slowdown. Now, as soon as the Fed starts hiking rates, we start a recovery phase. I don't know if we're going to go into recession or not, but when you start going into recession, a lot of the growth stocks go down a lot, and rate sensitive sectors go down. And Merrill Lynch says that's the time to start accumulating those. And we're not there. We're not here yet. We're still at the beginning of our slowdown. And whenever the Fed starts reducing interest rates and to get us out of recession, Merrill Lynch says that these are the sectors to start looking at. So I thought that'd be interesting. We'll go back to this Merrill Lynch investment clock whenever we move to a new section, maybe if we're in a recession or we're in a recovery mode. All right, so I updated this PE and bond yield chart to match the current bond yield. The current bond yield is around 3.8% or so. And what I did was I put an X. Okay, this is the blue chart is what the stock market's willing to pay for earnings in the S&P. And that's the PE. And the red chart is the current yield on a 10-year. So you can see the last time currently, we are paying far more for okay. So whenever the last time was 2009, we had a yield of 3.7-ish. At that time, we're willing to pay 13 PE. You can see that this is the PE right here. So we're willing to pay 13 PE at that time for a 3.7 yielding treasury. So now let's look at the next time. Here we had back here in the year 1957, we were willing to pay 13 PE for the S&P when we had a 3.7 yielding treasury. And that kind of is the same as right here, where in 1974, we were willing to pay 14%. So what that means is right now our PE in the stock market is 20. So we should be trading with the stock market around 13 or 14 if we have a historical norm for the stock market. So you have to be ready for the stock market to go down from a PE of 20 to a PE of 13 or 14 to have a reversion to the mean. All right. So the forward PE for, let me see, the forward PE for the S&P is 20.6. And the average over the last 10 years is 18. And the average, let me see, the 5-year average is 20. That was a good little exercise. Okay, we've been tracking this since the beginning of the year, the first to worst. Last year, healthcare, energy, consumer staples, utilities did the worst. And our prediction at the beginning of this year, the worst will be the first. And look at this, the first week where the utilities is doing better than every other sector. And consumer staples is one of the best sectors also. Energy still is underperforming. The tech stocks dropped 5% this week or more. So that's why you have this this 17, 16% compared to last week. All right, so our theories are coming true. Losers of last year will be winners of this year's, and the opposite for winners might be losers. All the AI stocks dropped this week. We had some of the weight loss drugs losing some momentum, but we still have that theme of weight loss and AI revolution for the growth stocks we're following this week. And I guess the utilities are outperforming because they're involved in the build out of the data centers. The data center is going to require a lot of energy, and utilities, there'll be increased demand for their services. All right, so we see from this the year to date utilities index first week at the top. What else do we have to see here? Okay. Let's look at some of the, hold on for a second. Okay. Let's look at some of the market movers. We see a lot of stocks in the top 10 here. These are very rate sensitive stocks. Okay, let's look at some of them here. Let's look at D.R. Horton. They're an example of a stock that they are a home builder, and they cater towards the low end of the housing world. So they make very inexpensive new houses. The demand for houses will go up as interest rates go down. So we also see Zoetis is it's a company that does drugs for pets, I think. And they were spun off for another company, but I guess they don't have a relation to interest rates. Pulte Group, that's an example of another home builder. I guess they're a ritzy home builder that cater towards people that aren't interest rate sensitive, but the demand of housing for Pulte Group will go up as interest rates go down. AT&T is going up because as interest rates go down, it's going to be very hard to get a yield. And AT&T is a reliable 5.6% yield right now. That's going to be hard to get in a year. What other stocks do we see here? United Airlines is going up. They are heavily in debt. So as interest rates go down on a 10-year, the refinancing costs will go down. So you have, let's see, Crown Castle. Okay, I can't see any other correlations there. The top decliners, you see data center build out AI all over this. Monolithic power systems AI build out, that's the electricity for the data centers. NXP semiconductors, you have a lot of semiconductors in here. You have Supermicro, you have Broadcom. All right, so I'm not sure why Tesla is down. A lot of the Magnificent Seven stocks went down this week. It could be for profit taking. It could be the whole stock market was waiting for September to be a bad month. And I don't know. But Broadcom went down. This is one that we've been following for a while. It's been a little bit expensive. We're going to go over that today a little bit and to see what a lot of times when you have a sell-off, this went down 10%. That is a lot for a big company to go down. They had like an earnings release last week, and that kind of made participants sell it off. But a lot of times, whenever you have a good stock that goes down, it trades down to its PEG ratio of 1, meaning its fair value. So we're gonna concentrate on this week sell-offs in the stock market and how to understand if a stock is at its fair value or not. And right now, it just happens to be that Broadcom went down 10%, and it's basically back to its a PEG ratio of 1, meaning it's fairly valued. Okay, so let's look at what's going up and down in NASDAQ. That's interesting. Not a lot of stocks in the NASDAQ are up to date. The best performing stock is up 1%. Okay, so it was a down day for sure. We already saw a lot of these in the negative here. We have NVIDIA, Alphabet, a lot of the ARM holdings. A lot of these are AI poster childs that have gone up a lot this year. All right, so let's look at some more of our talking points. Okay, Dan Niles picks from the beginning of the year. Amazon is it went down 5% or more this week. It's only up 12% this year. Meta is turning out to be the best performing stock of his picks at 41%. Texas Instrument up 15%. XBI, the small cap biotech, is up 8%. KWeb negative 5%, one of the worst performing sectors. The Chinese ETF, Chinese tech stock ETF. All right, so let's look at some of the earnings coming out for this coming week. The big one on Monday is going to be Oracle. And a lot of these are smaller companies, so they don't have much of an influence on the stock market. I like to look at the ones that will have a big impact. We have Adobe coming out on Thursday. Adobe will have a lot to say about AI offerings, and everyone will be looking at their subscription annual recurring revenues. So, but for the most part, earnings are almost over. These are just the last couple ones coming in at the end. But the most important thing this week is going to be government information, and those two, the debate and Apple's conference. All right, let's look at some charts of interest. We see Google, Alphabet. We see we see that it's oversold right now, and it broke through. Let me see. It looks like it's starting this little downtrend. I made this. It broke through its 150-day moving average like last week. We have another antitrust lawsuit starting tomorrow for Google. So it looks like Google could be starting this little downtrend. I don't know. I drew some trend lines, and it looks like there's some support right here, and we might go into this pattern after we hit this trend line down here. I'm not sure. But we're oversold right now on Google. So we'll see what happens at this antitrust meeting on Monday. But I'm not sure exactly what's going to happen with Google. It's one of my biggest positions, and I'm not selling it because I think even if they broke up Google, 20 Googles would be more powerful than one. And I think there's a lot of smart people saying that the sum of the parts are worth more than what it's trading for right now. So in other words, Waymo, if that was his own company, that would trade for a lot more than what it's being valued right now. So that's kind of a dangerous, precarious situation if they break it up and if their remedy for fixing Google is to make Google share their profits with every company, or allow everyone to use their data and they don't get anything from that, that could be bad. So how they, but the interesting thing that the probability is that they're going to appeal this and it won't be 10 years before this is over. And if that happens, then Google's already monopoly for 10 years. So we'll see what happens. Okay, another interesting chart. Okay, it's Meta. You can see that it was in an uptrend for quite a while. This black line. It seems like it could be consolidating into like a sideways pattern. I don't know, but we have this um, bottom. We have it's basically at its 150-day moving average, which is definitely support. So it looks like this is an awesome time to buy Meta if you have some cash and you're not invested yet in it, because it's right at its 150. It's approaching its trend line, and it's one of the stocks going to be benefiting from political spending this year. That's probably hasn't been reported yet for them. So they're oversold and right at a trend line. That's awesome. Let's look at MasterCard and Visa. What I did was I put MasterCard and Visa on the same chart, compared them. You can see that their charts are almost identical. They have to be, they move together um, all the time, basically. So whenever you see um, one of the stocks breaking out and the other one hasn't broken out yet, that's a really good indication the other one's coming around the corner. Let's look at an example. We can see that Visa broke out of this downtrend like right here, and MasterCard, let's look at this. It broke out of its downward trend like right there. So I've held Visa since it IPO'd. So I'm just doing this as an exercise and just to if I had new money and I wanted to put some in, I would be able to notice that it broke out of this downtrend right here, and then you can hope for higher highs and higher lows. All right, so let's look at Apple. You can see this is one of the best performing stocks since beginning of May. Um, the interesting thing is this stock has been going up pretty steadily. A lot of times we have this buy on the rumor, sell on a news that happens. Right now we have the developer conference coming around the bend. We have a little bit oversold there, but we have gone up a lot, like 30 some percent in a short amount of time. And this is just like we were saying a week or two ago, whenever NVIDIA was going to report its earnings, we said everyone was buying it until that earnings date and then selling the news. And that's exactly what happened. They sold on the news. So you have to do the opposite sometimes of the stock market, of conventional wisdom. And conventional wisdom, if it keeps going, no, if most investors will say, oh, it's going up, so it'll keep going up. But and you have a catalyst, everyone sees the catalyst of the iPhone 16 coming out on Tuesday. So a contrarian would say, okay, well, that's already priced in. It'll probably go down. So let's see if that happens or not. For me, I'm a long-term holder. I've held it since 2012, I think. So I'm not going to sell based on a little chart action here, but I know that they're growing 10% a year for the next couple of years. Let's look at let's look let's just look for fun. Just because we haven't checked on in on this for a while. Okay, E-Trade's where I go for earnings estimates. You can actually get an E-Trade account for $50 if you put $50 in, and you can get all this great research. It's amazing. So right now, Apple is trading at the PE of 34. And let's look at the earnings. Earnings, they look like they're going up like 10% a year for the next couple of years. Let's do the math. See, in order to figure out year-over-year growth, we're going to divide the year 670 by 613. So let's do that. 670 divided by 613. That is 10% growth. So 7.48 divided by 6.7, we see 11% growth. So 8.43 divided by 7.48, 12% growth. Okay, so it's going around 12%, 10 or 12% a year for the next foreseeable next couple of years. So that, in addition to a dividend, which is maybe around 1% or less, that is going to allow me to have a total return of 11% or so if I buy and hold this. But you have to be willing for a lot of volatility. Okay, let's go back to our talking points. Okay, so Barron's had an article, why D.R. Horton is the home builder stock to buy right now. They mentioned the housing market has been really bad after a post-COVID frenzy. Lower rates and demand for starter homes should provide a tailwind for the shares. That's their investing theme. You see. Okay, so basically, I didn't have access to this article, but I said, well, I'll take that tip and I'll do my own research. All right, thanks, Baron, for that tip. We're going to look at the 20-year chart for D.R. Horton. No, I mean, not 20, that's 5 years. You can see that it's in an uptrend over time. In the past year or so, we had a good, yeah, it's been going up in anticipation of lower interest rates. And so you can see that it's ran up and it's at an all-time high right now, basically. So I thought it'd be interesting to look at the financials on this company, see if it's even worth looking at. So I divided the 23 by 24, etc. And I found that they're not growing that much. They're growing, Yahoo Finance thinks they're growing at 17%. What I see here is they're growing around 9% for the next 2 years, and then 17% after that. So if they were growing at 17% consistently, then Yahoo's finance of PEG ratio of 0.62 would make sense. But I think they're growing around 12% if you divide everything out. So the PEG ratio is 0.9 and they're 10% undervalued. So maybe Barron's had something here. Let's look at the statistics for D.R. Horton. They have a market cap of 60 billion. Of that 60 billion, you have a net 3 billion in debt. That's not a whole lot to have in debt. So I only okay, so the forward PE is 11 and the PEG ratio, according to Yahoo Finance, is 0.62. So Yahoo thinks it's around half priced. Its profit margin is good at 13, and that's our minimum, basically. Our return on equity is almost double what our minimum is. So all the numbers kind of match up for us. The dividend that they have on the stock, what is it? That dividend they don't pay much of a dividend, like 1%. 1% dividend yield is what they have. So maybe the total return. So if it's growing around 12%, its total return is 13%. That doesn't excite me too much. I would wait for a stock like this to go down a lot, knowing that we've done our math. So we'll wait for this to go down a little bit more. Um, it is a volatile stock. You can see that it goes up and down in a major way sometimes. All right, that was a good little exercise. Um, we saw from our top 10 stocks in the stock market, market movers, you saw Broadcom was like the #1 stock going down. So what we're going to do is we're going to see a lot of times whenever the stock sells off in integers in like 10 at a time, like 10%, that is a good time to see if that stock still has a good story behind it. I looked at the numbers for Broadcom's earnings estimates, and they they had really good growth numbers there. Surprisingly, they had, let me see, so they're growing around 22% if you average all these out. Their PE ratio is currently at 22, so that means it's fairly valued. A lot of times when you have sell-offs in the stock market, like the pandemic or any kind of major sell-off, the quality stocks will trade down to their fair value. And this is just an example of, wow, it actually did go down to a fair value. So it has a dividend of 2%, so the total return will be 24% per year. So they have the tailwinds. Let me see. I mixed these up. Tailwinds. Okay, so the headwinds for this company, things that will help the company, that will hurt the company, are the chip business is very cyclical. So that means if we go into a recession, this company is going to have an extreme downtrend in its stock. There's big ups and downs in chip manufacturers. Sometimes companies pre-order and they order more than they need, and then the next quarter they don't make that sale. They have been doing really good at beating their earnings. Look at that. Green, green. You don't see much of that anymore. You can see that it's amazing how their earnings went down so much in 2022 to 23. I'm not sure why that happened. But let's look at some of the good things about the company. They acquired VMware, and that's used in data centers right now. And it's going to be very, as the AI data centers build out, they're going to be getting more business from that. They're diversifying their offerings. They used to offer maybe some chips for cell phones before, but now they're actually expanding into other areas, such as software. Um, okay, so this is an example of a fairly valued stock. I like to buy stocks when they're undervalued. So we're going to keep our eye on Broadcom. It sold off 10% last week, down to a fair value. Um, we're gonna watch this and see if it goes down anymore. Okay. So I just wrote a couple of things down here about um, crashes, just because we had a 4.5% correction last week. You have to remember that does the market event causing the crash affect your position in a 1 year or 10 years? So let's look at what happened last week. We had a payroll report, job numbers that came out, and it spooked the market. Maybe we're going into recession. If we're going into recession, how does that affect quality stocks? And um, we're going to take a look at, you know, some quality stocks in the next screen and see if like a recession would really hurt those stocks. Um, what we did with this Broadcom is you have to look at the um, fair value of not only stocks but ETFs. The net asset values of ETFs will trade wildly when the stock market is selling off. So you'd have the SPY, for instance, is the S&P 500 ETF. That would tend to trade below its net asset value. Some of the less liquid ones, the ETFs, will trade far below their net asset value. So you get a really big discount on ETFs in a sell-off. Quality stocks and indexes will trade down to a peg ratio of 1. So just like we're going to show a couple of stocks later on in our screener that we can see where the peg ratio of 1 is. A lot of times when you have a 10 to 20% crash in a short amount of time, there's usually a recovery in a few within a short amount of time. In the COVID crash, we had a recovery within a couple months. So the worst thing you can do is when the stocks are going down, you don't want to sell everything off because you have you have some problems. One is you got to decide when to sell, and you have to find a replacement, something that's better. You can't buy the same stock if you sell it for a loss. So you have to replace it with something that's better than what you sold, and you have to know when to get back in. So all these makes it very, very hard to sell a stock and get back in a sell-off. And whenever you sell a stock and you make a gain, you have to pay around 20% to capital gains on that sale. What I did just for an example, let's say we had a crash. We had another COVID crash this week, and we did a screen. What I did was I screened for the highest capitalized stocks that fit our criteria. So the capitalization, you can see I sorted by this field right here. Now, what I would do if there was a crash, I would look for peg ratio less than 1 or around 1. So you can see Google right now, Alphabet is trading around a peg ratio of 1. It's probably less than that because they have a lot of cash. But you can see that if you divide the security price by the peg ratio, you'll get the fair value of the stock if these numbers are right. So Eli Lilly, for instance, it's trading above its fair value. So its peg ratio is 1.52 right now. So that means its fair value is 592. So if we had a stock market crash, everything was going down together. Some of the highest quality stocks will trade down to their fair value. So this is an easy way. I just did a spreadsheet calculation of security price divided by peg ratio. We got the fair value. So you can see what I did was I highlighted some of the stocks that are undervalued, such as T-Mobile and Morgan Stanley, Total Energies, Progressive, KKR. So let's say if Progressive was selling off, and we can see the security price is 248 currently. If its peg ratio is 0.48, then its fair value is 512. So you can see that if the stock is worth 512 and you buy it for 248, then you're getting some margin of safety when you buy it. So so I would look, if we had a stock market sell-off, I would look in this screen for all stocks that are below their peg ratio of 1 as a good starter for stocks to look at to buy in a sell-off. And also, I would look at the dividend yield. What Jim Cramer says is accidental high dividend yielding stocks. Sometimes in sell-offs, you have dividend yields go up to 5 or 7%. I remember in the COVID crash, I bought AbbVie when it was trading like 80 some dollars a share, and it was a yield of 8%. And I said, wow, I got an 8% accidental high yielding stock And that's turns out to be one of my biggest positions now after that. So we'll look at both the PEG ratio and the dividend yield. And we might be able to find a blue chip stock that pays a high dividend yield. And that combination is like amazing if you get it at the right time. All right, so that was a good little exercise. I just want to review a couple things here because we are at a period of time where there's going to be some market volatility this month, and I just want to review these rules I follow. Okay, so when we're following a chart, we have these trend lines. The black is the trend lines, and we have a stochastics chart, slow stochastics chart on the bottom of this chart. You can see that when it gets around 20 of the slow stochastics, that's the time to buy. And it usually matches, if it matches at the same time that the stock chart is at the bottom of its trading range, that's a double confirmation. That's a good time to buy. That's usually when there's fear in the market or there's fear in regarding that stock. The opposite is true, is if you get to a point where it's at the top of its range and the stochastics are high, around 90 or more. That's an indication it's time to sell. Right now, we're actually almost at a point to buy in in the indexes. So you can see where we're at the 20 in the stochastics, that's sold off. We're almost at the bottom. I guess the true signal would be right here if we came down to this level. But a lot of times it doesn't go down the whole way to the bottom of the trend line. It did right here. Look at that. It was at the bottom of its range and we were oversold. And one other time right here, you can see that we were oversold and we're at the bottom of this range. You can see this in May, we had it go down to here. No, we had it oversold, but it didn't go down to the bottom of the trend line at that time. So, all right, that's one little, that's good to review that every now and then. The last thing I wanted to review is we do this like once a month or so. Why I do these charts, what rules we follow for growth stock investing. The formula that I use for buying reliable stocks for buy and hold is return on equity greater than or equal to 12, profit margin greater than 12, market cap greater than 50 billion. A lot of times market caps over 50 billion are more reliable. Forward PE. If you compare that to its growth rate, and it's favorable. For instance, if a PE, well, we'll explain that next. We want the growth rate to be greater than 10, and we get that by dividing the years in the consensus estimates. Divide this year by this year, that gives you the growth rate between those years. And the PEG ratio, we try to buy less than or equal to 1. That means that they're quality companies with consistent earnings. Well, that means it's trading at its growth rate. So if you had a PE of 10 and it's growing at 10, then its PEG ratio will be 1. All right, and there's some other intangible things. We look at high free cash flow. We want a company to have a competitive edge. We always look at the dividend. That adds to a total return. Little or no debt, and the company has good management. Okay, so those are all things we look for on a regular basis. I'm like a growth stock investor. I've been doing pretty good. I think I have a good, decent formula here. I try to follow what Warren Buffett does. Okay, that's basically it for today. I hope you had a really good investing week this week, and I hope next week turns out really good for you too. All right, I'll see you next time.